Hey, Philip. There's another question naturally we're getting. I have heard from clients saying they don't really want to travel in the South, and it's not as politically motivated as it may come across. I really think it has a lot more to do with the dollar.
Mhm.
So if you're forecasting the dollar, which is one of the most difficult things to do, but I think it might be clearer in this environment, what can you tell our clients?
Right. So when we look at the dollar, it's all about the difference in interest rates between Canada and the United States. So when we look at the most recent inflation print, it was 2.8%, actually 3% in the United States, 1.8% in Canada. So what that tells us is the Bank of Canada is more likely to cut rates more often this year than the Federal Reserve. So as our interest rates are lower than the US interest rates, that's going to put downward pressure on the Canadian dollar. We're hovering around 70 cents today. We've been as low as 68 during some of the tariff noise. We think the fair value range is closer to about 67. So between 67 and 69 is where we think we're going to end up over the course of the next 3 to 6 months. So the worst is behind us, but it's not going to get better anytime soon.
Yeah, and I think you know what, for clients, there's a pain point, right? There's a pain point of exchange where they go, I'm just comfortable with this, but now it's getting uncomfortable. And just a little bit from what I'm hearing, I think we may be on that uncomfortable edge right now.
It is, but one of the ways that my team and I think about it is, yes, you are paying a little bit more for your US dollars, but you're also making more on your US dollar investments.
You are.
And so there is an offset there. It's
That's
not
right.
quite as painful as we think.
Yeah, absolutely right. Okay. So, Philip, as I've been having meetings through this year, clients are saying to me, man, it is crazy, particularly like say over the last 3.5 weeks, and of course, and the Trump tariffs come up, and the Trump tariff threat, I call it the triple T. But what they're saying is, man, our portfolios must be getting beat up with all of this crazy volatility. I haven't noticed volatility. And as a matter of fact, portfolios are up. I mean, on an annualized basis, they're up around if annualized, it'd be like 24, 25%.
hmm
I mean, it's early in the year, but it's totally different than what they believe.
Exactly.
Why is that?
Well, and this is where we make a difference between the headlines and the noise versus the fundamentals. And you mentioned it earlier, when we talk about the fundamentals, it's how are the companies doing? Well, here's how the companies are doing. When we look at the S&P 500, we have fourth quarter earnings that have come out. We're almost done with fourth quarter earnings season. And what we've seen is that the majority of companies have surprised to the upside, meaning they've beat expectations. And it's about 76% of companies have surprised to the upside. And total earnings growth year over year is averaging about 12%.
Huge.
That's a good environment.
That's
exactly.
very good.
And the market is more focused on company results than political headlines. And
Yeah.
that's the important distinction with portfolio management is don't let the noise interfere with the fundamentals.
Yeah. A question was asked of me yesterday, as a matter of fact, by a client. And they said, is this the craziest market environment you've ever seen? And I said, not even close, because there actually hasn't been a market environment yet. Right? Anyway,
Exactly.
right? Certainly threats of tariffs, but again, these would all be long. It's not like you can put a tariff on tomorrow anyway, right? So there would be reactions and those kind of things. And that's worst case scenario for everybody because nobody wins, as we say. There is something negotiating around that. But what the client said is, yeah, how bad is it, right? And you've been in this business a very long time. And I'm going to tell you, in my experience, the two worst events I have ever come across in my career was in 2008, right? With the financial, really, collapse is almost the right word, right?
Yep.
And then the pandemic.
You're absolutely right.
Yeah.
Yeah, in '08, we had, between '08, '09, and for a couple years after that, we had hundreds of banks in the United States fail, close their doors. There were many companies. We saw Lehman's close its doors, Bear Stearns, Wachovia, Washington Mutual needed to be bailed out. That's not where we are today. That we are nowhere near that situation. But that was a very scary time where globally we were on the financial precipice. And then as you point out during COVID, those were crazy years as well. We didn't know what was going on, and we saw the market drop 35% in the span of 23 trading days.
Incredible.
Exactly. And there you had to have some faith that we were going to see our way out of it. Today is nothing like that at all.
No. And the reason I'm bringing it up, too, for the clients that have been with us for that period of time, and many have been with us for 20, 25, 30 years, what we have gone through in the past, some of that has been really serious. And yet, if you were to pull out a statement from 2008 and look today, my goodness, what has changed? Look at what happened from 2000 at the start of the pandemic to today, meaning time, right? And institutional money management that is prudent, right, continues to sail its way through. And again, I'm just very happy to have you here, Philip. Thank you very much for coming to Kelowna.
Oh, my great pleasure. Thank you for having me.
And freeze.
Yes.
Yeah.